Good morning, everybody, and welcome to Managing Funds Responsibly. This is the last in our current Fiscal Resilience webinar series. Next slide, please. To get started, I'll be covering some housekeeping. Today, we do have the following accommodation services for this event. We have ASL interpretation. That is happening right now on screen. So for best viewing, please update your personal WebEx layout to active speaker and thumbnail or grid view. We also have CART live captioning happening on this webinar. So live captioning is viewable in the multimedia viewer, which should be on your screen now. You may have a button that is a little blue button that says allow. That's safe. That's the live transcription. You can change the size and the style of the font to suit your needs within this multimedia viewer window. And if you cannot see it, please go to View, Panels, Manage Panels, and Add Multimedia Viewer Panel. In addition, Blake is going to be sharing a link to the CART transcription. If you're unable to see the CART transcription within the WebEx window, you can insert this URL into any web browser, and it will show you the transcription live as it's occurring. Next slide, please. We also, if you're having trouble accessing audio for this meeting, please dial in. The phone number and the access code are listed on screen. Blake is also going to share the access code information in the chat right now. Next slide, please. Now to access the chat feature, I just talked a lot about the chat feature. You should see the chat feature on the panels on to the right of your screen. If you don't see this, if you move your cursor on the screen, a menu below will pop up with a bunch of circles. The chat box looks like a little speech bubble and it should be blue. If it is gray or black, click it, it'll be blue and that should show the chat. If you would like to chat to us, please make sure that you have your chat set up in the to form to all panelists. That will make sure that all of the people on the panelists are able to see it and not just the host or the presenter who may not see your question in a timely manner. We will be capturing Q&A via the chat function, so please rest assured, if you chat something in and we don't speak it right away, we will get to it, and we may have some actual Q&A sessions as well. But chat with us throughout if you have any questions or concerns. Next slide.
All right, well, thank you, Rachel. So again, everyone, welcome to the OVS VAP Training Center webinar I just lost my place, Managing Funds Responsibly. So I'm Blake Cush. I'm the Director of Training and Outreach at OVS. And this past April, we hosted a webinar on financial sustainability for victim assistance programs, where we reviewed the current landscape of VOCA funding and its still uncertain future. We understand that this financial environment comes with many challenges and questions. And building off of that initial discussion we had back in April, we helped develop this Building Your Program's Fiscal Resilience webinar series, with the hopes of helping you tackle some of these unique challenges. And as Rachel mentioned earlier, today's webinar is the fourth in that series, and each webinar is recorded. The links are made available on the OVS VAP Training Center webpage, as well as our OVS Training YouTube channel. As soon as you exit today's webinar, you'll be directed to an evaluation survey on the presentation. This is also a safe pop-up that will automatically open in your web browser as soon as you exit. Take a couple minutes if you can and give us your feedback. We really do use these evaluations to enhance future training opportunities. We can't do that without your input. We only had like 15 or 16 completions last time, and I'm really asking you guys, if you can, give us those 5 minutes, share your feedback about this. Since this is the last in this series as well, it's really important to share. If you've attended any of the other past webinars, share what you thought about it, what you think, and include some information in there about what you'd like to see in future opportunities. You'll also have an opportunity there to notify us if you're interested in receiving more training or follow-up on this or a variety of other training topics. Finally, today's webinar is led by Ginny Emsuits of JA Strategies and Alan Krieger of Krieger Solutions. These are our usual suspects. Ginny and Alan have more than 40 years of combined experience in consulting and training, working with nonprofits and agencies around the state of New York, and both have also served as executive directors of nonprofit organizations, and both have master's degrees in management. With that said, I'd like to formally get us started and welcome Ginny and Alan.
Okay, thanks, Blake. Yeah, slides for the webinar are just been put into the chat box. There's a link in there, so if you haven't gotten them yet, you want to click it, you can open it and you can follow along. You can also grab it later in the day. And again, I want to reinforce what Blake said about the evaluation. We'd love to get some feedback. One of the feedback statements we got was that you wanted us on camera. So we're trying to do that. It's a challenge to speak for an hour into a little machine and keep our eyes focused there, but we're going to do our best, and let us know how we do it if that's helpful. So our program today will provide you a broad overview of financial management, including some key terms and concepts that will be helpful to you in your work as a program or agency leader. We'll also briefly discuss the roles of various staff and leadership positions in the fiscal process, including agency leaders, program leaders, financial staff, and boards of directors, or other oversight bodies. Another important part of today's program will be looking at the budgeting process and how to create and use a program budget to help you better manage each program you lead. We'll also briefly look at financial reports, which often make program staff's eyes glaze over, and show you some simple things to look for and how it can be helpful for you to review these on a monthly basis. And from this, you'll learn to access and use financial data to help you with your program decision-making. In a minute, we're going to open 3 short polls that we'd like you to respond to. This will give us a better sense of who is on the webinar today, so we can try to tailor our presentation to your needs and interests. The first question will ask about your knowledge of financial management. We're guessing most people here have a limited understanding of it. We plan to provide a good, solid foundation, but if you have more expertise, we'd like to know. The next question asks about your role in the agency, so we can try to focus on those areas as well. And the final question is, do you work for a nonprofit agency, a public or government agency, or a private for-profit company? Financial jargon, processes, and rules all differ slightly with each of these 3 entities. Rachel's now going to open the polls, and we'll give you 1 minute to answer all 3 questions. It should pop up on your screen. Be sure to scroll down so you can see all the questions. And when you're finished, hit submit at the bottom, and we'll see what the results are. Okay, it's really helpful if everybody could answer these. We've got 30 seconds left. We'd really like to know who we're talking to so we can make this as a good fit as possible. It's 15 seconds left. Make sure you hit submit at the bottom after you answer all 3 questions.
Maybe we do Jeopardy music next time.
Okay, time is up. Rachel's going to process the results, and we'll have them up in about 15 seconds. So just stay tuned, and we'll take a look at who we have with us here on the program today. Okay, there are the results. Okay, so good. Very few people here are very knowledgeable, so you won't catch our mistakes. But if you were somewhat knowledgeable, that's good. So again, some of this will be a review, but we hope there'll also be a lot of new information. And please feel free to chat in any questions you have or anything you want to take it to a more advanced level. We're happy to do that. Who's with us today are mostly program supervisors, are the largest group. And again, that's really who we're targeting this to. Those of you that are in a senior leadership role have a different level of responsibility. We're happy again to answer questions about that, but our focus will be on the program level for the most part. We've got some fiscal staff. I imagine you're the very knowledgeable folks we have, and certainly chime in if you have other suggestions or ways that the program staff can better interact with you, or issues or concerns that come up. And we'd like to hear from your perspective as well. Financial management is a team sport, and we need everybody playing together well. Okay, and the vast majority are from nonprofit agencies. And again, the rules vary a little bit. The jargon varies a little bit as you move between the 3 entities. We have nobody in the private for-profit, so we won't be addressing that except with a few stray comments here and there, just so you have a sense of it. And for government, again, much of it is pretty much the same. When we talk about a board of directors, In a government agency, you have some kind of oversight body for the most part, and in some cases, it's just the commissioner without any kind of a board. So it depends on what level you are, but the elected officials are the upper level. So in state government, it would be the governor and the legislature, and county government, it would be the county legislature and county exec taking on that role we call board of directors. Okay, great. So this is a very helpful list. We have a good idea of who we're working with, and we will try to make this as customized as we can. But again, if there's something we say that doesn't really fit from your perspective, please use the chat box and chat in to all presenters, all panelists, so we can all see your comments. Okay, and so now we have our first open chat question. I'm sure many of you came here to just get a good foundation, and we're going to provide that. But if you have any specific questions, such as terms you've heard that you didn't understand, or reports you were asked to look at that didn't mean much to you, or procedures that seemed unnecessarily cumbersome, please type them into the chat box right now. We'll try to answer them at the appropriate time. We may not answer them all right now. We'll fit them in as we go. And throughout the program, if questions come up, please feel free to type them in. So if you have just a general, you just want an overview, we're going to give you that. But if you have anything specific you want, please note those in the chat. See, I've got to find the chat box. For some reason, there we go. Okay, nothing yet.
Nothing yet. Yep.
All right, so Jenny will let me know if any others come in. We're going to try not to use any jargon that we don't define, but if we slip and we say something and it's a word you don't know, please chat in questions about any of those terms. Okay, so we're going to move on to our presentation now with an introduction. And since most of you are from nonprofits, here's a question that comes up a lot. Can a nonprofit agency show a profit? I'll give you a minute to chat in if you know the answer or think you do. We have one brave soul that responded. Okay, so we had a mixed vote there. We had the yeses outweighed the no's, and the answer is yes. Absolutely yes. Not only is it allowed to have a profit, but it's actually a good idea. The healthy nonprofit will want to have some cash in reserve so that it can be ready if there's an unexpected downturn or shortfall, or if it needs to quickly respond to a new opportunity. The next question is, what's the limit on how much money a nonprofit can accumulate in 1 year as a profit? Anybody have any idea of what, again, chat in?
Remember to type your response to all panelists or all participants.
Okay, no idea, no idea. Okay, good. Then we're going to teach you something. So there is no limit. There are many nonprofits with multi-million-dollar endowment funds, and they take in large amounts of money each year. You hear about that with big universities, but also a lot of large nonprofits, hospitals. A number of them have endowment funds in the $1 million and up range. So what makes a nonprofit is that there are no owners who benefit from the agency's profits. Any net income, any profit that's left over after expenses is reinvested in the services the agency provides. So don't think of your organization as a nonprofit, but think of it as a not-for-profit business, a business that's exempt from taxes. A nonprofit that loses money each year quickly becomes out of business. So that's why understanding these concepts is so important. Let's take a look at the goals of the financial system. Why do we have such a complex system in place? The first purpose of the financial system is obviously to record all financial transactions, and this recording is done to meet two other goals. One is to provide a system of checks and balances to help ensure the best use of funds and to reduce risks of fraud. And the final goal is to provide useful data to all levels within the organization and to funders and regulators and even banks to help with the effective functioning of the organization. We're going to focus on how the system can help you as a manager, but it's helpful to a wide range of groups and people. Okay, so there are various levels in the organization. As I mentioned earlier, we're going to divide them into two for our purposes today. One is the leadership level, which sets the overall vision and direction and focus strategically on the big picture. The other is the management level, which operates day to day to make sure the programs are operated effectively and are in line with leadership's vision. There are roles for both the board and the staff in the financial management system. The board and senior staff operate at a more strategic leadership level, and program directors and supervisory staff operate at a more day-to-day tactical level. We're going to focus on the program director's supervisory role during this program, but again, we're happy to answer any questions about more senior levels. Non-financial managers, along with financial staff, have a number of responsibilities. They need to follow the accountability system set by the agency and make sure they're complying with all policies, procedures, and standards that are set, both internally and by outside funders or regulators. This includes helping create and be aware of the budget and then monitoring it to make sure all revenue and expenditures are in line with expectations. Managers need to collect and report accurately and timely on all fiscal-related matters and to read and understand key financial reports, and we're going to help you with that today. And annually, before the new fiscal year starts, they need to recommend and develop the annual budget, which is approved by the board. And throughout, they need to be sure that their actions are in line with the mission of the agency. And with nonprofits, you have to be sure that you're true to the exempt purpose under which the agency operates. Let's take a quick look at the basic bookkeeping or financial record keeping process. It's actually pretty simple. Money comes into the agency to provide needed services. It goes into a bank account of some kind, and then it gets spent on appropriate budgeted expenses. That's the easy part. Now, Jenny's going to look at some of the more challenging parts of the financial management system to help us solve a few financial mysteries.
Thanks, Alan. It does seem simple, but there are some things that make it a little bit more confusing and puzzling. And so we're going to raise some of these right now and answer them for you. And so here is our first mystery. How is it possible that an agency can earn income and not receive any money? So income or revenue can come in a number of ways. It can come in the way we normally think of it as money. That is, it can come in the form of cash and checks or even credit card payments. But it also can come in what we call a receivable. That means somebody promised to give us money and it's due to us right now, but we won't actually get the cash until sometime later. In accounting, we consider it income or revenue on the day it was promised to us, or in some cases on the day we spent or invoiced for the money that we will be reimbursed for later. So, and then you all know about that, for getting your OVS reimbursements. But that's called a receivable, and that's an important word and concept for us to understand. We don't have the money in hand, but it is due to us. And finally, revenue or income can sometimes be in kind. This means that it's a non-cash contribution. In-kind revenue could be somebody volunteering their time, which has real value, but no money is changing hands. Or it could be a donation of food or materials or supplies that we use in our programs. Again, no money has changed hands, but the time or the donations cover real expenses your program would have had to incur if these things were not donated. So in-kind revenue is often used by programs and agencies as part of the required match for government and foundation contracts. Therefore, it's really important to keep track of this type of revenue. The concepts we just addressed are part of what's called accrual-based accounting. We accrue the revenue in our records, even if we don't have the cash in hand. And likewise, we accrue expenses when we're making them, even if we don't actually pay the cash. Most of us at home operate on a cash-based accounting system. We consider ourselves to have income when we receive our paycheck, and we record our expenses when we purchase things. And while there are some community-based organizations that still operate on a cash basis, the majority of organizations use this accrual-based system. In a very similar way, our second mystery is related to how an agency can incur expenses and not spend any cash at all. So when we incur expenses, they can be recorded in several ways as well. First, they can be an expense, just as we understand this when we pay for things right away. There are also such things as in-kind expenses, which exactly mirror the in-kind revenue we just talked about. As you may already know, in financial management, it's important that things balance out. So every in-kind donation that we receive and we put in our books, we also needs to be also shown as an in-kind expense, since these expenses are critical to our program. For example, if no one had donated food to our program, we would have had to go out and spend money to buy it. So even though no money changed hands, it's important that in-kind expenses be recorded to show the true cost of the program and to make sure that you don't show a false surplus. A third kind of expense is called a payable. This is when we've incurred an expense, but we're not paying for it right away. This is something we all do in our personal life when we purchase things using our credit card. At that moment, we've incurred the expense, but it's a payable for us and a receivable for the credit card company. They'll send us a bill later, which we're obligated to pay at some point. In the world of accrual-based accounting, all expenses are recorded on the date we make the purchase, whether we pay for it that day or not. Here's another accounting term that's good to know. The word is liability. And in this case, it refers to money you or your agency owes to someone else, but haven't paid yet. An outstanding loan is a liability. And so is the telephone bill that you've received but aren't planning to pay until the end of the month. So here's our third mystery for the day. How can money go out of our bank account and no expense be recorded? And so I want to look at another important accounting term, and that's assets. An asset is something of value to your agency. It's something tangible, such as property. We often use the word assets to describe people and talent. You are all assets to your supervisors and programs. But in accounting, it's a much narrower, we have a much narrower view of what assets are. And we look primarily at property and equipment, such as your assets. So cash, money in the bank, and investments, these are all also considered assets. So if you purchase a building or an expensive piece of large equipment that will last for many years, there's no expense recorded in that transaction. And that's because you're simply trading cash, which is one of your assets, for equipment, which is a different asset. Now you all know if you purchase a copy machine, sometime within 5 to 10 years, and sometimes shorter these days, you probably need to replace it. So the accountants have come up with a strategy to show that in financial records. They reduce the value of the asset each year until it eventually goes to zero. And so this is called depreciation.
Jenny, before we go further, we had one question that was, how is a liability different from a payable?
So as a good,
sorry.
you want to answer? I was going to say,
Yeah.
so yeah, a liability, actually they are for the most part the same thing. Payables is what we term them when we use them, and then you can clarify it even further. Payables, on a day-to-day basis, these are the things that are paying out. A liability is how we show it on a balance sheet. So your payables are one part of your liability. So it may be, but there may be other liabilities. Alan, do you have something clear to?
Yeah, maybe other liabilities could be if you've taken out a loan or a mortgage or anything that you've borrowed, that's a liability. You have to pay it back. And I think those are the two main ones, right?
Right.
Payables
Right.
and liabilities. And,
right. So payable is something so your loan payment, if you get a bill for your loan payment, that would be your payable. The bigger liability is the total amount that you owe for your loan. All right, so now we've solved a few mysteries. Maybe we've created a few more. We're going to take a quick overview of the financial management system, and then we'll get into more depth about that in a few minutes. The process begins with the board setting a budget, and that's based on staff input, hopefully. And usually the program staff do a first draft. Then throughout the year, the staff manages the program's income and expenses, reporting them all to the bookkeeper who record the transactions. Reports are generally issued monthly, and the records should be in balance. So someone should be checking the records against the bank statement to reconcile all your bank accounts. There's a report called the balance sheet that we'll talk about, and which, as the name indicates, should show that things are in balance. And the other major report is the profit and loss statement, also known in the nonprofit world as the statement of activities or as the income statement. And we're going to review these reports in a little more depth later in the webinar. So here's a quick review of the key terms we've talked about so far. And we're going to pause now and see if anybody has any additional questions about what each of these mean. The only two we haven't mentioned and we won't be mentioning are debit and credit. these terms don't necessarily mean what it sounds like they mean. And while bookkeepers and accountants need to know them, if they start using those words with you, you can ask them instead to speak regular English and use it language that you're going to understand a little bit better. So again, if anybody has any questions and would like us to clarify any of these terms a little bit more, please feel free to type them into the chat box now. Give you about 30 seconds. Sometimes there's a delay between when people chat in. Okay, so while people are chatting, and I'm going to talk a little bit about the accrual method again, and Alan pipe in. So cash accounting is, I'm going to just talk about the difference. So cash accounting is the here and now. You know, you have as much money as your bank account shows that you have, and that's it. So today I have $20. If I get a check in the mail for $100, then I will have $120. Accrual-based accounting is recognizing things that are owed to you or that you owe. So that if I have billed somebody for that $100, I have $20 in my bank account now, but I've sent out an invoice for the other $100, my assets, how much money I have in accrual-based accounting is already $120. My bank account only shows $20, but I have accrued the other revenue. I have billed for it. It's work that I've done. So that I'm worth $120. And so it's recognizing income that you have earned but have not yet been paid for, and it's also recognizing the fact that you have expenses. You've ordered something, you've ordered supplies online, and you're going to get an invoice for them. If you ordered $100 worth of expenses or of supplies online, then that $100 will come out of your, your official, how much you're worth. So if I had $120 in the bank right now, so my, if you looked at my bank account and I had $120 in the bank right now, but I also had just ordered $100 worth of supplies, then I would be worth $20 because I have accrued that expense. Alan, do you want to add anything?
With accrual accounting, what works for me is to think it's really a time shift from when the cash moves in and out to when we make decisions that will impact our value. And we all do this at home. If you use a credit card, that you may have, $200 in the bank, and you've just purchased $500 of things on your credit card. You still have $200 in the bank, but not really. You're $300 in debt. So accrual accounting recognizes that as soon as you make that purchase, you're now in debt and you need to do something to get some other revenue to offset it. So it looks at kind of what your true value is at any moment in time based on who owes you money and who you owe money to. So it's mostly just shifting the time period when things happen, as opposed to how we would do it in common sense.
And one of the reasons that organizations use it is so that they know how much money they're going to need to pay in the future, so they have an accurate picture of what's going on. So one of the things that accrual-based accounting is important for, so even paychecks. So think about it. We all only, most people get paid every 2 weeks. Some people get paid once a month. Every day that you work, an organization is accruing that expense that, if you worked on Monday, they owe you for that work on Monday, and then Tuesday, they owe you for that work on Tuesday. So at the end of the 2 weeks, you have accrued that as revenue. That's money that's owed to you, and the organization has accrued that as an expense. That's money that they need to pay out. So even if it looks like they have plenty of cash on that, the first Friday, the first week in, they know, they're one of the reasons it's important to accrue expenses is so that you realize that, yeah, I can't spend that on a new copy machine because I'm going to have to pay it out a week later in salaries. So hopefully that clarified it a little. We can talk about it a little later. We're going to do a quick poll now that just gets a sense of how many people we're totally confusing and how many people are following, because we know that this, for people who are not financial managers, this can be a confusing topic. So right now we'd like to check in and see how everybody's doing. So please take we're going to give you 30 seconds to answer the following questions. Are you so far following everything pretty easily? Maybe mostly following, but still have a few questions around some of the harder topics. Are you pretty confused, or are you totally confused? So Rachel, if you can launch the poll now. And one of the things that I will talk about while we wait for the poll, once you've answered your questions, is we're going to talk at the end. If at the end of the webinar you still are totally confused, we are available through the Training and Technical Assistance Request Program to set up time to work with you on some of these things, and we'll talk more about that later. But you have you still have last second now, so hopefully everybody's answered. We'll give it 20 seconds to process. And if you are totally still pretty confused, feel free to chat in to all panelists the things that you'd like us to review. All right, great. So it looks like we're doing pretty well. Some of you didn't answer. Hopefully you're not so overwhelmed that you just couldn't even click the button. But most of you are easily following everything. And there are a few of you that may be, pretty confused or a little bit confused. For those of you who are feeling pretty confused, as I said, if you get to the end of the webinar and you're still pretty confused, we'll give you a link and you can set up a time to talk to me or to talk to Alan. And we can walk you through either the concepts again, or even help you review your own financial statements or some of the key things. Remember, you don't really need to memorize any of this. This is just hopefully to give you a better sense of what the fiscal staff are working on, and some of the things that they're talking about when they're talking about printing out reports and closing the books and asking you to do certain things to account for your expenses or your revenue. We are going to be discussing some of the key reports that you'll need to review, but before that, Alan is going to take us through the process of how we build our program and agency budgets, which are the foundation of our fiscal process.
Before we move on to that, may I just jump in for 1 second? We have
Absolutely.
lost video on our ASL interpreter, so I'm not sure if he's aware of that, but if he could troubleshoot that, we're going to keep going. If you were using the ASL interpreter, we apologize for the inconvenience, and the CART transcription is happening in the multimedia viewer. Oh, he's back. Wonderful. Thank you.
Okay, so developing and improving the budget is the first step in any fiscal cycle. The budget, as I said earlier, is a strategic decision regarding where you want to focus your resources. And as such, it's actually a policy statement by the board or whoever the decision-making body is. It takes time to develop a good budget, and it requires input from all levels of leadership. As noted on the slide, there are budgets that are specific to each program, and then there's an overall budget for the entire organization. Budgets primarily address revenue and expenses, but they also can take into account cash flow issues. The first step in developing a program budget is to have a clear description of your program. Those of you who are on the grant writing webinar may remember we talked about the logic model, which includes what you want to accomplish, what you're going to do to accomplish it, and what resources you need to support these activities. This includes how many staff, what their salaries and benefits would be, any supplies or equipment or facilities needed, and any travel expenses. Understanding payroll taxes and fringe benefits is pretty complicated, so that's where your fiscal staff can come in to assist. Another accounting term we haven't mentioned yet is allocation. This is a very important concept. Each program in your agency takes some of your executive director's time and some of your finance staff's time. In addition, each program needs some of the space in your building and should share in the utility costs, use of any equipment, and other general expenses that are considered overhead. So a key element of program budgeting is figuring out how much each program will pay for these costs. Allocation reflects how the expenses are shared among programs. This can be calculated in a number of different ways. And your agency may actually use 2 or more of these ways in the same budget. Costs for the executive director's time could be based on the number of staff each program has. So if your agency had 100 staff and your program has 20 staff, you might be charged 20% of the executive director's time. The finance staff could be charged the same way, but could also be charged based on the total dollars each program brings in. So if your agency's budget is $100,000 and your program budget is $30,000, then you would be charged 30% of the total cost of the finance staff. Rent and utilities could be based on the total square footage of the building and what percent of that your program occupies. Another approach could be to base on the number of staff, figuring each person takes up a comparable amount of space. To keep things easy, many agencies choose one of these methods and apply it to all shared or allocated expenses. As long as there's a rational basis for the allocation method you choose and it's applied equally and fairly, that should be acceptable. Okay, there's a question. Is this webinar really aimed at the entire entity financial management as opposed to just individual grant management? As managing grants for a state agency, I would never incur an expense not covered by the grant or state match as detailed in the original budget submission. Okay, yeah, there was also an earlier comment about when we have a grant, we always spend it down at the end of the year, so we don't have any profit. And so grants are a unique and large part of your revenue stream. And grants are, we're going to talk a little bit later, are restricted. You can't spend the grant money on something that's not covered in your budget, in your grant contract, in your grant budget. But you may have other expenses that you have to incur. And way back when I was an executive director of a small agency, and we were entirely grant funded. We had no money that wasn't grant funded. And we had to go buy batteries for a calculator or something. And we submitted an invoice for batteries as part of our supplies. And batteries hadn't been listed in our grant as an allowable expense. So we were disallowed. And I had to pay the $7 myself out of my own pocket for the batteries because we had no money, which is why it's important that you do develop some sort of revenue stream. And we'll talk about that in a few minutes, so that you have some money to pay for unexpected expenses or expenses that are outside your grant funding. So for most of you, grant funding is 90% or more of your income. And in those cases, you have to really be on the lookout for where are we going to get other revenue to cover these expenses that come up, or to expand and grow into areas that our grants don't currently fund. So we'll talk about that in just a minute. So in fact, here's the revenue slide. So once you have expenses sorted out, the next step is to look at your revenue. Start with identifying what revenue sources you can confidently count on for the coming year. Will that be enough to fully fund your program, or at least the core elements of your program? So you know you have a grant that should be good for next year, and chances are it's going to come through. You're going to budget as if it's coming through. But if it's a long shot, then you may not want to put that in your budget at the same degree of certainty. So you want to think about additional funding sources and assess their likelihood of being approved. Could you maybe increase the size of your grants, or could you increase donations that you've received in the past? Think about any additional funds you could raise, perhaps by charging a fee for your services. Some agencies have expanded their educational services to corporations for their staff development, and they've raised money that way. So they have these educators that are skilled and trained in providing services to the community at no charge, funded by the grant. But then there's a corporation that wants similar training for their staff. Well, they can charge them and have some revenue that they can use for other purposes. And we're not going to get into it here. We have to be careful. If your educators are paid 100% by a grant and you're getting revenue from a corporation, you can't charge the educators to the grant for that piece. So things get complicated. Again, that's where you consult with your fiscal staff when you try to do something new and different like this. But it's totally legal and appropriate, and a great way to bring in some revenue that's discretionary and that you can use how you need and how you want. But think hard before you start a fund development program that includes fundraising events. These are hard work and hard to make a profit. We discussed this in our previous webinar on fund development. There's a recording of that if you want to take a look at some of the fund development ideas we shared as a way to bring in some additional revenue. Think about other funding sources in your community that might support your mission, such as a community foundation or large local employers, and explore the possibility of securing additional funds from them. When you have a realistic figure for revenue, then go back to your expense budget. And if the expenses exceed the revenue, begin the hard process of scaling back your program until it matches the revenue. Magical thinking is not helpful here. We have to make some hard decisions. So once all the program budgets are complete, you can roll them up into an agency budget. We have a few reminders for you to think about during your budget process to make the budget especially useful. While we've said this about many planning processes, it's worth repeating here. It's important to start early. The more time you give yourself to create your budget, the more time you will have for input and feedback. And that's what makes your budget accurate. As you think about your agency budget, remember to be clear about your goals. Are you looking to reduce the size of your budget? Is this a growth budget? Are you hoping to create a budget surplus at the end of the year? Or is this a break-even budget? Again, as somebody said earlier, with a grant, if you don't spend your grant, it's not a surplus to you. It goes back to the funder. So again, grant funds you do want to spend completely, as somebody identified, but other kinds of funds that you take in, such as a service fee or a donation, you want to try to hold on to those and not spend them all. And that's a surplus that you can use going forward. So evaluate your budget and think about where you might have existing or potential gaps. Maybe one of your programs was understaffed last year and you want to expand that next year, or you need to hire another staff person to fill some kind of increased contract. Make sure you're aware of these issues before you put numbers into your spreadsheet. In the same way, you want to examine all your revenue lines. Too often we have seen programs or agencies with budget shortfalls because they use the same revenue numbers in their budgets year to year, even though they knew they were losing a temporary grant or one of their contracts was likely to be reduced. That brings me to my next point. Your budget should be realistic. You can put in some goals, maybe increasing revenue in certain areas, but make sure these goals are things that you can realistically achieve. Once you've drafted your budget, take a look at it and make sure the way you're planning on spending money aligns with the mission of your organization. You should be spending the most money on programs that are closest to your mission and less on ancillary programs. If you're increasing spending in a certain area, will it help you get closer to achieving your mission? And finally, think about contingencies. If certain revenue does not come in as expected, plan now for where you will make the difficult cuts that you hope won't happen. We mentioned this earlier, but I want to emphasize how important it is to involve staff at all levels in the budgeting process. Many times it's something that just the director and the finance director do behind closed doors, giving only cursory information to program supervisors and directors. But there are many reasons why it's important to broaden the number of people involved. First, it provides transparency within your organization. Involving your program supervisors in the process also helps them build their own leadership skills and ownership of their programs. Program staff really do know their programs and what their needs are, so they may be able to provide some kind of different insight about what funding increases will have the biggest impact and what funding cuts will have the smallest. Finally, involving everyone in the process so that it's more transparent and inclusive helps prevent that us versus them mindset that happens in a lot of organizations, between different programs when funds are tight, or between management and staff. So starting from the bottom up with program budgets to build the agency budget can positively engage all staff in the process and help maintain morale when revenue is tight. Once you have your budget in place, it's important to be able to track your income and expenses to be sure they align with your budget. And if they vary, you'll know you need to make some adjustments. So here's a list again of financial reports that you may need to know about. They'll help you monitor your program and agency financial status. The income statement, as Jenny mentioned earlier, also goes by P&L or profit and loss statement. You might also occasionally see statement of activities, as she mentioned earlier. While the income statement just shows numbers from the current year, a more useful version of this report is when it's compared to budget, or compared to the previous year or previous time period in a year-to-year comparison. The balance sheet we mentioned earlier shows your assets and liabilities and your net assets or equity. Jenny will review both of these reports in just a few minutes. Another important report for the director to be aware of is the summary of receivables to see who owes you how much and how far past due they are. This can impact your cash flow. We mentioned earlier that a good financial management system provides important data, and taking it one level further, data that is presented in a useful way provides good information. For those of you who have worked with your current financial system, take a minute and think about what kinds of information you get from your financial reports. And what else would you like to know about your financial status? Please chat in anything you can think of that you'd like to know more about from your financial system. Give you a minute to chat in any thoughts as those of you have worked with your reports. If there are things that are missing or you're not able to see what you think you need to see, let us know and we can kind of talk about maybe how you can find that. And if you haven't worked with financial reports yet, Jenny's going to give you a nice introduction in just a minute. Okay, as Jenny said earlier, you don't have to memorize everything we've been talking about. Your finance office needs to fully understand and act on all this, and they do. But program staff and agencies leaders need to have enough of an understanding of these things so you can help develop the budget and you can track your fiscal activity throughout the year. So the rest of the webinar is going to focus on the key report that will help you with that tracking, the income statement. And we'll also look briefly at the balance sheet. See, I think we have a comment here. Keeping track of how much money we have at the end of each quarter. Yeah, so some reports are done monthly, some are quarterly, but certainly we don't want to wait a year to find out. So it's important to read your statements, and if you're not getting them monthly or quarterly, make sure you're getting them at least quarterly. Now with computerized systems, it's very easy to generate all these reports.
And the second, yeah, there was another comment about it's difficult to monitor or spend down of grants throughout the reports that the finance office sends out.
Okay, so again, you can talk, Jenny's going to talk about how the income statement can be broken down even by grant, and you could ask your finance office to give you maybe not all through the year, but halfway through the year, and then the third quarter, and then monthly through the last quarter. How are we doing and where are we? And again, this is where allocation comes in, because you may have, ordered something that you haven't paid for, but it's charged to the year that you ordered in. Technically order and receive the equipment in, even if you don't pay for it in that year. So you can kind of figure it out at the last minute and make your payments in the next month, in the next fiscal year for the previous year, as long as you've incurred the expense through that allocation. Okay, so Jenny's going to take us through what these reports might look like, and in that she'll talk about how you can monitor your grant expenditures.
Thanks, Alan. So we're going to take a closer, as Alan said, we're going to take a closer look at some of the reports we've been mentioning. Many of these reports are that if you're in a nonprofit organization, these are the reports we're talking about are the ones that the board is going to get, maybe on a monthly basis, maybe on a quarterly basis, but they're the same reports that give a sense of, where the organization is at any period of time. And then we're going to talk a little bit about how some of those reports can be, to be made more useful for you. So the first one we're going to look at is the income statement, and that's the one that reports on your revenue and expenses over a period of time. And it's generally monthly, quarterly, and annually. Some organizations just do monthly and annually. So this is a key report, and it's known by many names. I think we talked about it earlier. It's often called the profit and loss or the P&L statement. In the private sector, it's mostly called the P&L statement, but it's also called the income statement or the statement of revenue and expenditures. It's a really useful report, and so it's collected a number of names over the years. Officially, and in your annual audit, which we're not really going to talk about today, it's called the statement of activities, and that's because it tracks the financial activity of your program or agency, the money that's coming in and the money that's going out. And so, as I said, that's how it's referred to on the audit reports. But most often you'll hear it referred to as the P&L or the income statement.
Jenny, we have a question. Somebody caught me. I used a term we didn't define and asked about it. The term is encumbrance or encumber. And it's a lot like the word incur. You've incurred an expense, but you haven't paid for it yet. So you've encumbered the expense, or you've encumbered revenue that you haven't gotten yet, but you can encumber it and show it on your financial statements as money we have. But it's usually done with expenses that we've encumbered an expense. So we've ordered a piece of equipment. We've paid for some kind of a contract activity. We've rented a facility to do a fundraiser in, and so we've encumbered the expense. We haven't written the check yet, but but it's on our books. So it's a payable is often encumbered is the term used for how that's recorded in our books.
Yeah, and when you see it related to revenue, it's often, somebody donates $10,000 and they haven't put any restrictions on it. And we'll talk about restrictions later, but the board or the director decides they're going to use that at the end of the year for staff bonuses. And so at that point, those funds are encumbered for that purpose. You can't use them for anything else because you've encumbered them for that purpose. So it's the same idea. It's a restriction ultimately. So back to the income statement. So this is, here's an example of what the bottom lines of a report will show. So this, at the end of the report, the top half of the report generally shows your income or your revenue, and the bottom line there shows your total income. The lower half of your report shows your expenses, and the bottom line will show your total expenses. In the report here, you see that expenses exceeded income by about $3,500, and and this is reported as your net ordinary income. The other income line that you see here is generally interest or investment income, and that does get added into your revenue, so that and that's what results in your final profit or loss amount. In this case, is a loss for the agency of $2,600, give or take, $22,631. So while most people jump right down to the bottom line, it's important for leaders to fully understand every single line of this report. Note that if you don't look at these types of reports all the time, depending on your agency, negative numbers can be shown in several different ways. In addition to the minus sign, which we've used here in the report, they are frequently shown in a red font. And we've also done that here, but they also can be shown within parentheses, which is an accounting sign for a negative number. So if you see 2,631 with parentheses around it, you know that that's actually negative $2,631. This next slide shows what the income part of the income statement or the P&L might look like. And hopefully you see that this is not a hard report to understand. In this example, the program had 3 sources of income. They charged fees for some of their services, so they made about $2,600 for that. They did some fundraising, and then they received some grants. If an organization is receiving both government contracts and foundation grants, you'll often see these as 2 separate lines. Now, on the next slide is an example of the expenses part of the report. Notice that the fundraising expenses are listed here, and that reduces the net profit of any fundraising activity. Other expenses are for payroll costs and salaries, various supplies, repairs, and maintenance. So totaled up, they show the total ordinary expenses. As we mentioned, there is a benefit of regularly reviewing reports, and that's because they can provide you with some valuable information about your programs and your agency. Here are some of the kinds of analyses that you might want to do using these reports to get a clear fiscal picture of your operation. So in most and many organizations, salaries are by far the largest expense. And so understanding just how large the salary expense is can really help you when you're thinking about what you can do if you need to cut expenses in times that budgets are tight. So in this case, and this agency, over 96% of the budget is salaries and payroll taxes. There really is nothing else that could be cut to make up a shortfall. Sometimes we go for the lowest hanging fruit, like, okay, we're going to cut office supplies. But if you understand that 96.5% of your budget is salary and payroll taxes, then you're not going to be able to make up much by cutting, office supplies. Another important analysis is how much you rely on your grant income, which could quickly disappear, and how much you rely on income you raise yourself. In this case, 90% of all the overall income is grant income. So, there's $35,500 in grant income. The overall income for the organization is just under $40,000. So 90% of the overall income is grant income. And that's not unusual, especially for victim service programs. So what we don't know in this case is how many different grants make up this amount. So it's $35,500. If it's, if the fewer number of grants that make up that money, the more at risk the program will be if one or more of those major grants dries up. So I want you to take a few minutes when you get a chance and look at this report for your program or for your agency and do a little analysis to become more familiar with your overall finances. This income statement or statement of activities can be run for the whole agency, and and that's, as I said, what the board often sees. But it also can be run for a specific program or even a specific grant to show the income and expenses for each one. So I think that the person who raised the issue of not being able to kind of track how the grant is spending down, if you were able to run an income statement just for your grant program, this would give you a better idea how much of the money has been billed so far, how many expenses have been, what's your income for that grant so far, and how many expenses have you already incurred against it. To make the income statement even more valuable, it can be run compared to your budget. I think Alan mentioned that earlier. This allows you to compare both by percentage and by dollar amount the difference between what you proposed in your budget and what you're actually doing during your operations. We call these variances. And while it's important not to have some variances, it's not to have too many variances in many of the budget lines, variances of, it's impossible. I'm sorry, not important. It's impossible to not have variances. Nothing ever comes in the way we think it's going to come in. But variances of large amounts need to be addressed immediately, or at least understood. Another useful version of the report compares a current period, either month or year, to the prior period. So if your program has not changed greatly, it should be similar to the prior month and similar to the prior year at this time. Most accounting systems can easily prepare these reports, and this gives you a better perspective of your overall financial situation and and how your program is running. Another term that you may hear is fund accounting. And what that means is the financial system is divided up into different fund areas, each representing a different program or grant fund. In the corporate world and some nonprofits, these are called cost centers. The most useful statements of activities report for a program director is one that is broken out for your program only. It can be further broken down by fund areas representing different grants that support your program. So you'll be able to track each grant and see how much expense has been incurred against that grant. So but that requires doing some coding of your expenses and making sure that the fiscal system is set up to really track these cost centers. So if you don't know at this point if your organization does that, it may be worth talking to your fiscal director. So in the case of the person who wants to have a better sense of how the grant is being spent down, having a conversation to see if that's being tracked in the fiscal system or not. And it may mean that they need to add some coding so that they can create that cost center that's just specific to that grant. So the other report we've mentioned several times that you may hear about often is called the Statement of Financial Positions, or more often we just call it the balance sheet. And this is where your assets and liabilities are reported. It shows the overall value of your agency at a specific point in time, and that's considered your financial position. So that's why it's the Statement of Financial Position. As we discussed earlier, your assets are things your agency has, things that have tangible value, like your bank accounts and your investments and large equipment. Any receivables you have are also considered assets. It's money that you are owed. So your liabilities are loans or other debts you have and bills which you haven't paid yet. And your equity is known as your net assets or your fund balance. And the net assets represent the overall value of your organization once you subtract your liabilities from your assets. At the end of each year, your equity or net assets is the positive or negative overall value of your agency, which is also called your fund balance. And then the profit or loss from that year gets incorporated into your fund balance or retained earnings. And this is the value you hold on to after all your expenses and liabilities are accounted for. So if your fund balance or net assets were $100,000 at the beginning of the year, and you showed a $25,000 surplus on your income statement at the end of the year, your net assets would be $125,000. Often in not-for-profit organizations, your net assets will be listed in 3 different categories. Those are going to be your unrestricted funds, your funds that are temporarily restricted, and funds that are permanently restricted. And these may not be things that you see on a regular basis, but they should be things that are reflected on your balance sheet. And it's important to make note of these, especially if you are at a leadership level, because it'll allow you to better understand how much money you actually have to use in emergency situations. The unrestricted funds are exactly that. They're the funds that have come into the organization with no strings attached. So those usually through donations, fundraising events, but with no strings attached. And those are the ones that you use if you find yourself with an emergency expense. Let's say you need a new roof, you can use your unrestricted net assets to pay for that expense. The temporarily restricted funds are assets that come into your organization for a specific purpose, but haven't even used yet. So an example of a temporarily restricted asset would be a $20,000 grant that you receive in 2021, and it's supposed to be spread over 2 years. So you have $10,000 to use this year, you have $10,000 to use in the second year. The $10,000 for the second year would show as temporarily restricted net assets in 2021. You're not allowed to use that $10,000 in 2021. It's temporarily restricted because they're earmarked for the second year of the program. In 2022, those funds can be used for the purpose of the grant, and so they will no longer be they won't be recorded as temporarily restricted funds anymore. Permanently restricted funds are usually those that make up endowments and scholarship funds, and those are funds that have been permanently dedicated to certain accounts by their donors or by the board. As a result, you're restricted from using the funds, usually most of the funds themselves. You can use only the interest off the funds and the income that comes from the investments, or sometimes you're able to use a small percentage that's determined by the funds charter. So even if you have $1 million in the bank, if that $1 million is made up of funds that are permanently restricted to an endowment, you can't use any of those to replace your leaky roof. So, and that can be really confusing, but for staff and for some board members, we have this huge expense. It looks like we have plenty of cash in the bank if you're lucky enough to have an endowment, but you are legally restricted for using it, and you can and you can get in some trouble if somebody audits you and that funding isn't there anymore. So we've given you a lot of information and we're coming to the end of our webinar. So we do want to hear the additional questions that you might have, the things that you're still confused about. We'd also like to hear if you've picked up anything new that you're going to take back to your agency. So please take us a few seconds now to chat those ideas, those questions in. Please make sure you chat them into all panelists so that we all see them. And we'll give you a chance to do that now. But while we are waiting for those questions to come in, we're going to take a couple minutes just to review the technical and training and technical assistance request program that's sponsored by OVS and that we've mentioned already, and hopefully most of you have heard about, but we do like to remind people about it. So if we want to go on to the next slide, we are able to provide training, coaching, and consulting to OVS funded programs at no cost to your agency. You can find out more information about it at the website that's listed here, but we are going to give you an idea of some sample projects that would relate directly to financial management. So we can provide in-depth training for program managers and executive directors on developing and managing budgets or on other aspects of financial management that you want to learn a little bit more about. This has been a quick overview, and so for those of you who are new to it or who think that other people in your agency or department might find it useful, we can come in and do that. We can also consult with the program the agency administration, your program staff, and your finance office to create a budgeting process for your organization, including working on program budgeting and tracking. We can help you review your current financial reports and make suggestions for changes that can help paint a clearer picture for you of your organization's overall fiscal situation and how individual programs are operating in relation to the budget. And if you are not clear about how to read your financial reports and you still have some questions after today, we can have just a short conversation with you or a short session with you where we actually go over your reports and help you identify what you want to look for when you read them and help you understand them a little bit better. So please continue to type in your questions or key takeaways you have. I'm going to turn it over to Blake in a minute to wrap up the webinar, but we are going to stay on and answer all of your questions. But I know it's already afternoon, and so some of you may need to leave. But please, if you have questions and you do need to leave, feel free to email us. Our email addresses are here, but always make make sure you please answer the survey when it pops up. It takes only a few seconds, and we'd love to hear about it, hear what you have to say.
The last question on the survey also gives you a chance to ask us to contact you, and we'd be happy to do that. So if you'd like more follow-up for any reason, just put that on the last question of the survey and we'll be in touch. Blake?
Yeah, so if you have to sign up, we understand. I do want to, before you do leave though, give a special thank you to Ginny and Alan for putting together today's webinar. As they said, please, please, please take advantage of that survey and share some feedback with us. And also, I cannot reiterate this enough, take advantage of the TARP program. It's free. All of those projects they just talked about would be completely free for you, and there's only a limited number of months left in the program. So please, while it's still here, submit a request. It's really, really simple. But if you have to jump off, that's fine. We appreciate it. Thank you for joining us. If not, stick around and we'll go through some questions.
Okay, so we had a question about can you get a link for the recording and a copy of the PowerPoint? Yes, if you go to the OVS training website, all the webinars recordings are there, and this will get loaded within a few days. Rachel, copy of the PowerPoint. I know it's in the slides here, but is it included? It's also on the website too, right?
Yep, and it'll be in the YouTube notes section as well for the video link. So.
Okay, lots of opportunities for that.
And I did want to mention, somebody did chat in to say, and I think just to me, that temporarily the restricted funds now often are titled as funds with donor restrictions and without donor restrictions. So the permanently restricted and unrestricted is older terminologies, and so so you may see it as with donor restrictions and without donor restrictions. And related to that, there was one question about permanently restricted funds. Can they only be used for specific expenses, such as for a particular program or client, but not any other expense? That generally are temporarily restricted funds, so they've come in for a specific purpose, and so you can only use it for that purpose, but as soon as you use it for that purpose, you can spend the money. Permanently restricted funds are generally kept in a permanent fund, and so those are really mostly in organizations that have been lucky enough to have endowment funds or scholarship funds that have built up over the year. And those funds are usually are restricted permanently. So somebody gave you $1 million and they said, you can use the income off of this fund to help support your programs. So it's permanently restricted for that. It sits in that bank account every year. It does, 5% in interest, you get 5% of interest off of it. And so you can use that $50,000 towards your program. But the $1 million is permanently restricted towards that scholarship fund or towards that endowment fund. You can't ever use it. Temporarily restricted funds are restricted until they are, until you use them for the purpose for which they were donated.
Okay, and somebody said that they're taking back the importance of involving a broad range of folks in the budget development process. We're happy to see that. That's an important point for us, and that it pays a lot of dividends, as we said earlier. So that's great. And then somebody asked, what type of income can be included in program income if you're putting grants and donations separately?
Fees.
Sure,
So those would be your program fees. So if you charge for some of your counseling services, if you're also running a youth program that has an after-school program and people pay a small fee for that, that's your direct program income. Maybe you sell t-shirts, that's program income. So anything and we didn't really talk about earned versus unearned income because that's getting a little bit into the weeds, but that's the income that you earn, that is often your program income, and then your grants and those would be listed as unearned income, but it's separate.
Okay. Again, the link to the slides just got posted in the chat box, so you should be able to click on that and access it. Any other questions? We're happy to stay on a few more minutes if people want to chat anything else in.
It may make more sense if you do go back and look at your your financial statements to see if there are things that you may have been doing accrual accounting all this time and you just didn't realize it.
Yeah, and again, as Blake and Jenny mentioned, we're available. This is confusing. And those of you that have seen financial reports with no orientation, you just don't even know where to start. They're actually not that hard, and we can guide you through it, and then you'll be able to pick it up very quickly and know what to look for and how to read them. So we're available. We're happy to help. Webinars are tough. We give you a lot of information. We can't see if your eyes have glazed over or not. The earlier polls said most of you were following, which is great.
But that was before we got to the financial statements.
We did that intentionally, yeah. So. All right, so go check out our catalog on the Training and Technical Assistance website. As Blake mentioned, the clock is ticking down, and we have a number of agencies we've been working with closely, but there's a whole lot of you that we haven't worked with at all, and we're happy to be available. So there's the link to the Training and Technical Assistance website.
And since this is our last scheduled webinar, we are planning to do some additional ones over the next few months. But if there's a topic that we haven't covered that you really like to hear more about, please answer that survey and put it in there, or send me an email, send Alan an email. Maybe we can go back to the previous slide that has our email addresses on it, because we'd love to hear that. We are trying to get a sense from the people that we work with what might be useful. But if you have an idea for a webinar, we'd love to hear it.
All right.
And there's our emails in the chat box. Make it even easier. Rachel's a
Yeah.
great facilitator here. So.
I think that's it. I think those are the last questions that I saw, but this was a wonderful webinar. We got a lot of feedback coming through to me that it was very helpful. So please keep that rolling. If you need more assistance, we cannot enough say do TARP. Get your requests in now, because what we don't want to happen is they all come in at the end. So get your requests in now, even if you're not quite ready to start. But it's a wonderful, wonderful opportunity that we're happy to provide for you.
Yeah, and if you do want to do training over the summer, now is a good time to get it, because we will, our time will be limited out during those summer months.
Yeah.
Okay.
All right. Thank you.
Well, thank you, everyone.
Thank you. Have a wonderful day.